The market handed us a masterclass in human predictability this week. While everyone else panicked about Oracle's financing issues and AI stock rotation, those who understand behavioral patterns saw exactly what was coming and positioned accordingly. Most traders think market corrections are random events. They're not. They're the inevitable result of human psychology meeting mathematical reality, and this week proved it once again. I've spent years studying how theological anthropology intersects with market behavior, and what I witnessed from December 16th through 19th was textbook human imperfection playing out in real time. Fear, greed, and ego creating the exact patterns that disciplined investors exploit for profit. So today I'm going to break down the three layers of what really happened this week: the human psychology that drove the selling, the systematic patterns it created, and most importantly, how Stoic principles turn market volatility into opportunity. Because while the crowd was reacting emotionally, there was serious money to be made by those who remained disciplined. Let me start with what actually triggered this week's action. The S&P 500 fell for 4 consecutive sessions through Wednesday. The Nasdaq dropped 1.81% in a single day. Oracle plunged on data center financing concerns. Broadcom down 19% month to date. Bitcoin under pressure from Japanese bond yields hitting levels not seen since the 1990s. The financial media called it a tech rout and an AI bubble bursting. Complete nonsense. This was human psychology following a script written thousands of years ago. Here's the human layer of what really happened. The market entered the final trading week of 2025 with portfolios stretched by a year of AI-driven concentration. Portfolio managers faced a psychological reckoning. They were exhausted from overextension, but terrified of missing structural shifts. When Oracle's financing story broke, it didn't matter whether the project would ultimately succeed. What mattered was that it confirmed what many already suspected. Leverage and speculative build-out had outpaced demand certainty. The selling wasn't panic, it was rational recalibration. But here's where human nature becomes exploitable. The delayed economic data from the government shutdown created an information vacuum. Markets operate on pattern recognition, and when patterns are obscured, participants retreat to what they can measure. Fear of the unknown trumps analysis of the known, every time. Beneath the surface, a deeper behavioral dynamic played out. The fear of being wrong about positioning into 2026. The Fed's dot plot signaling only one rate cut next year clashed with market expectations. This dissonance forced a repricing that had nothing to do with fundamentals and everything to do with cognitive dissonance. Investors weren't fleeing stocks, they were repositioning within stocks to reduce sensitivity to uncertainty. Classic human behavior. When confused, take action that feels like control, even when the best action is often no action at all. Now here's how these predictable human behaviors created systematic patterns that smart money exploited. The system absorbed the selling pressure through clear technical levels. The S&P 500's breach of 6,750 activated algorithmic stop losses and volatility targeting strategies. Volume patterns confirmed distribution, declining issues outnumbered advancers, Nasdaq new lows exceeded highs by nearly 2 to 1. But this wasn't a liquidity event. It was orderly repricing of risk premium. The difference matters enormously. The sector rotation manifested in clear, measurable flows. Technology down 2.6% month to date, while financials absorbed capital on steeper yield curve expectations. The market was pricing in a regime where the Fed remains restrictive longer than anticipated. Meanwhile, the bond market told the real story. Despite the Fed's rate cut, the 10-year Treasury remained above 4%, up 50 basis points since September's easing began. The bond market wasn't buying the disinflation narrative. This kept real rates elevated, maintaining pressure on long-duration assets. Commodities split perfectly along predictable lines. Crude oil hit 4-year lows on oversupply concerns, but gold and silver continued their multi-year rally on sovereign risk, and yen carry trade unwinding. Industrial commodities down, monetary metals up, classic stagflationary positioning. Bitcoin's correlation with risk assets tightened as Japanese yields surged. The crypto market's sensitivity to Japanese monetary policy exposed its dependence on global liquidity flows rather than adoption narratives. When the cost of leverage rises in the world's largest creditor nation, speculative assets reprice first. Always. The system was functioning exactly as designed. The patterns were clear. The opportunities were obvious if you knew how to look, which brings us to the Stoic response: how disciplined investors turned this volatility into advantage. First principle, this behavior was neither irrational nor surprising. It was the natural consequence of valuations that had priced imperfection meeting reality that delivered ambiguity. The AI trade required flawless execution and infinite capital availability. When Oracle's financing came into question, the market's assumption of frictionless capital deployment was challenged. The system corrected not because the thesis was wrong, but because the path was less certain than the price implied. The rotation from growth to value wasn't rejection of innovation, it was acknowledgement of time preference. When the risk-free rate stays elevated and the Fed signals fewer cuts, the present value of distant cash flows compresses. This is arithmetic, not sentiment. The delayed economic data created a void that the market filled with volatility. In the absence of information, participants default to risk management. The selling was process-driven, not fear-driven. Portfolio managers facing year-end reviews reduced exposure to names that had contributed most to gains. Standard behavior, predictable timing, exploitable pattern. Thursday's inflation data provided the system with permission to stabilize. The 2.7% annual CPI reading allowed the Fed's easing narrative to remain intact without forcing immediate policy response. Cool enough to support risk assets, not so cool as to signal economic weakness. The market's rally wasn't euphoria, it was relief. The path forward remained navigable. Here's what the Stoic investor understood that others missed. The Japanese bond yield surge impacting Bitcoin illustrated a fundamental truth. All assets exist within a global liquidity framework. Bitcoin's decline wasn't a failure of the digital asset thesis, but a reflection of its position at the far end of the risk spectrum. Those who understand this relationship can position accordingly. Those who don't will be surprised by moves that are entirely predictable. The week's price action wasn't a warning, it was a reminder. Markets don't move in straight lines. Corrections within uptrends are features, not bugs. The system wasn't breaking, it was functioning. The participants who maintained discipline, who understood that volatility is the cost of participation, who didn't confuse short-term noise with long-term signal, they weren't shaken. They observed, adjusted, and prepared for the next phase. Because here's what separates systematic wealth builders from emotional traders. The market doesn't reward certainty, it rewards adaptability. While others panicked about Oracle's financing or worried about AI bubble bursting, disciplined investors saw Micron's earnings beat proving tangible AI infrastructure monetization. They saw Elliott Management's billion-dollar Lululemon stake signaling that operational improvement stories remain attractive when growth narratives falter. Capital still flows to clarity. The market wasn't rejecting growth, it was demanding proof. This is exploitable because human nature never changes. Fear, greed, and ego create the same patterns across decades, across asset classes, across market cycles. The names change, the underlying psychology remains constant. The Stoic approach is to observe these patterns without emotional attachment, to position based on probabilities rather than predictions, and to maintain discipline when others lose theirs. Second-level thinking means understanding that when everyone expects the Fed to cut rates aggressively and the Fed signals restraint, the repricing creates opportunity for those positioned correctly. The crowd reacts emotionally to headlines about financing issues and sector rotation. We remain disciplined and focus on what the data actually reveals about human behavior and systematic patterns. This week handed us a perfect case study in why markets remain exploitable, not because they're random, but because human beings are predictably irrational. The system rewards those who understand this truth and position accordingly. If you value systematic thinking over emotional reactions, if you want to understand how human psychology creates exploitable market patterns rather than just chase the latest headlines, then subscribe, because this channel is built for those who recognize that discipline and philosophical clarity create lasting wealth. The link in the description contains the complete framework for reading market behavior through the lens of human psychology and Stoic principles. Download it if you're ready to move beyond surface-level analysis and start thinking like the market makers who profit from everyone else's predictable mistakes.